afternoon. Welcome to today's IFRS webinar for the Creston community, the Creston family. As usual, you've all got your sound activated, and I've already had a couple of messages that tell me you know how to use the chat box. Remember, all of you have a muted microphone. That's for reasons of bandwidth. We've got 5 polled questions for today, which explore quite neatly, quite challenging. They explore aspects of IFRS 7. And of course, I'm delighted to hear from anybody by email after the event. So the agenda, we've got 2 items of news update. First of all, for those of you who are working in the European Union or have clients reporting back to the European Union, to perhaps a parent or investor, then there have been 3 endorsements by the European Union to just bring you up to speed. And then secondly, we're going to spend a few moments and address the progress that's made in the ISB Disclosure Initiative project. In fact, when we suggested this agenda with consultation with Andrew Collier 6 months ago, I was pretty confident that we might actually have got 1 or 2 stages further down the Disclosure Initiative project, but we can still bring you up to speed with the progress made to date. And then we're going to focus on a particularly large disclosure standard, IFRS 7. And that will take us through to the end of the day. So very briefly, 3 endorsements have taken place at the European Union. These occurred, the first of them, just literally a few days after I last broadcast to you. I think I broadcast to you on the 7th of March or something like that. And literally just a week later, the EU endorsed the amendment to IS 40, effective for the current year. Quite a simple amendment. There has to be evidenced change of use, not change of plan or change of management's intention, but evidenced actual change of use before a property is either transferred in or transferred out of the IS 40 investment property category. And then just a week later or so, in March, there was a technical amendment that was made to IFRS 9. It's an amendment that will probably have no impact to any of you. It was an issue that some of the world's larger banks encountered when they were planning their implementation of IFRS 9. And of course, IFRS 9 has taken effect for the current year, so ideally the amendment would have been effective from the 1st of January 2018, but because of the ISB's due process, they had to give at least 1 full year before mandatory requirements. So it became 1st of January 19, but then of course they immediately introduced that early adoption was possible. And the intelligence from the banking community, where I spend quite a bit of my time, the intelligence is that early adoption is a virtual certainty, because there really was no point in implementing IFRS 9 for this year and then an amendment to it for next year. So it's almost certain that everybody, if it affects them, will early adopt that prepayment negative compensation amendment. And then on the 3rd of April, the European Union were pretty busy then. Perhaps it was because there was so little progress from Britain on its exit negotiations. They found something better to do. On the 3rd of April, they endorsed IFRS 22, which is effective for the current year, and it clarifies that where there is an advance cash payment, now that might be from an entity to its supplier, from whom they're importing, so a supplier invoicing in a foreign currency, or equally a dispatch from an entity to a foreign customer. And what often happens is that there will be an advance cash payment in advance of the goods physically moving. And the question arose, what is the so-called date of the transaction for the purpose of foreign currency translation? And this IFRS interpretation has clarified that it is the date of those advance consideration payments or receipts that tells us the date of the transaction. So 3 European Union endorsements, and there are a couple more that are expected in the next 2 or 3 months. So for those of you practicing in the European Union, good idea to keep your eye on EU endorsements. Now, the other piece of news update, which perhaps I was hoping might have been a slightly more comprehensive session, but the lack of progress at the ISB has meant that this is really more of a news update, concerns the Disclosure Initiatives project. And this is a series of projects that address disclosure concerns. And these disclosure concerns were first explored and raised in that so-called discussion forum meeting, which took place in London on January 2013, where the great and the good, being bankers, central bankers, stock exchange, analysts and investment firms, auditors, preparers, and indeed, of course, standard setters, all came together for a day to discuss what is wrong with disclosure. And the backdrop to that was that perhaps it was clear that something was wrong. And I think it was that in the previous published HSBC financial statements, published in around March 2012, if I remember correctly, the HSBC financial statements physically weighed just over 2 kilograms. That's heavier than my laptop. I think it was some 680 pages. And somebody said, haven't we got something wrong with disclosure? And I'll give you an idea of the sort of observed problems on my next slide. Now, there are 2 stages of the response to that have been completed. One of them took effect January 16, one of them took effect January 17, and those were amendments to IS1 and IS7. I've got a single slide on each of them in just a moment. We have nearing completion an update to the definition of material, and that is simply to make consistent the new conceptual framework, which was published, of course, just 6 weeks ago, and the definition of material that's included in both IS1 and IS8. And there are a collection of further IAS8 changes that I need to bring to your attention. And then there is also a post-implementation review, PIR, of the segment standard, IFRS 8. Now, of course, that is famous for triggering many, many pages of disclosure, although admittedly only in the context of quoted companies. And then there's also a post-implementation review going on of the fair value standard, IFRS 13, which also tends to create quite extensive disclosures. Then we have, at a very early stage, very early because both of these projects were only initiated 3 weeks ago, is the start of a highly targeted standard level review of disclosures. That actually builds on an initiative that has been carried out over the last year or two by the Institute of Chartered Accountants in New Zealand. And they've been working on trying to build a more conceptual approach to disclosure. And they've used as a vehicle for that 2 or 3 standards, in particular IAS 16, property, plant and equipment. And there's also at a research stage a paper expected on the principles of disclosure. That's also building on the work that the New Zealand Institute have been carrying out. So at that discussion forum, a number of, I suppose we'd say, problems with disclosure were identified. Perhaps, there were 2 particular concerns. One was that the approach to disclosure has become one of compliance, tick boxing is often called, rather than the consideration that disclosure is an opportunity to communicate rather than comply. Regulators and auditors were found, in a sense, to be complicit in that approach, in the sense that it tends to be that regulators and auditors will take the line, well, probably best to disclose, rather than to hold an argument with a client as to what the materiality or the nature of a proposed disclosure is. It's also clear that the requirements in certain standards themselves are sometimes inconsistent, sometimes duplicative. It was observed that disclosures always seem to be added to, no history of taking away disclosures, unresponsive perhaps to changing environment, users, by that I mean particularly regulatory organizations, stock exchanges, things like that, somewhat perhaps not engage in a process of addressing disclosure. A lot of entities are increasingly using other channels of communication with investors, websites and so on, to tell the story. And so the danger is that the financial statements just become even more so a straight compliance exercise rather than an opportunity to explain and enlarge on the story of the last year. As I think many of you have observed, and as we should understand from the amendment to IAS 1, sometimes, because of an inappropriate understanding of materiality, the relevant information gets obscured. In other words, we over-disclose with the danger that key messages are perhaps not apparent. And of course, a complaint that I dare say many of you have come across, some of you might even be guilty of providing boilerplate type disclosures. Boilerplate refers to lifted from a publication, typically either descriptions of accounting policies, just literally copied and pasted from the standards, or illustrative disclosures, copied and pasted from some sort of good group, illustrative financials. All of the big four, of course, publish for public consumption illustrative financial statements. And so often we see boilerplate. In other words, no attempt to tailor a disclosure to a particular client's circumstances. Not many years ago, there was an engineering company here in the UK who had a disclosure about their accounting policy for animals. They had no animals, but they had an accounting policy for it, just in case. And that's perhaps an indication of the danger of just copying and pasting standard sort of descriptions from standards or illustrative financial statements, or last year, for want of a separate illustration. So the IFRS announced that they would rise to this challenge. And so the first thing they did, effective for 2016, was some amendments to IAS 1. Now, you've all lived with these now for already 2 full years. So it should be already assumed knowledge. Remember, they extended the concept of materiality to include the idea that you might over-disclose, over-include information, leading to the danger of obscured key financial information. This was an entirely new idea because historically, materiality had been about, have you got a full disclosure? It was addressed at omission and, to a slightly lesser degree, perhaps misstatement. And the attitude had always been, in a sense, if in doubt, then disclose. And what the amendment did here is to try and turn the circle back a little to suggest that you might actually lead to obscured financial messages by over-disclosure. In the light of that, they therefore clarified the relationship between materiality and disclosure requirements. They deleted a phrase. You remember that the list of line items in a balance sheet, particularly, slightly less so in the income statement, kicked off with the phrase, as a minimum, entities must. And that itself was leading to line items included that were simply not material. So they deleted that phrase. They also pointed out that an alternative to introducing additional lines on the face of an income statement or a balance sheet would be to have disaggregated disclosure in the notes. But that led also then to the need to clarify how additional subtotals might be computed and presented. They extended our understanding of systematic manner for the structuring of the notes. Systematic manner does not necessarily mean that the first note you have is a 20-page essay on accounting policies. Maybe your first note should be the biggest single number, which might be revenue. And therefore, they also suggested, why don't you consider having a quantitative disclosure immediately followed by its qualitative disclosures, including a description of accounting policy. So on that basis, therefore, the accounting policy for deferred tax liabilities, typically, would be perhaps as part of Note 30, rather than part of an enormous essay as Note 1, quite often. And an expanded description then of what is required in accounting policy disclosures. They also took the opportunity of deleting 2 examples that I have described as rogue, and they were just unhelpful. In fact, they were positively dangerous illustrations. They just got rid of them, simple as that. So that became effective from the 1st of January 16, prospective application. 2017, they added the debt reconciliation disclosure. I mean, again, you have to say this is adding rather than subtracting from disclosures. They added the debt reconciliation disclosure, effective from January 17 prospectively, a reconciliation that might look like this on slide 11. In other words, it would be filling the loss of audit trail between a disclosure on the balance sheet last year For example, total debt 3690, with this year's balance sheet total 4230, you find in the cash flow statement 460 repayment, and then you scratch your head and you think, well, hold on, that doesn't actually work. And of course, it is typically newly acquired subsidiaries that bring with them, in this case, 600 of debt, or the other way around, a disposed of subsidiary that takes with it a pile of debt, or it could be the accounting for new finance leases. Of course, at this point in time, IAS 17 was still in place. Fairly minor point on slide 12, they're just needing, now that we've got the conceptual framework finished, published, I remember, about 6 or 7 weeks ago, they now need to just simply make sure that the definition in IAS 1 and 8 of the concept of materiality is fully formally comments about obscuring material items with immaterial information. We're expecting project direction to be made clear sometime this month. So I was perhaps hoping, when I set up this year's Creston webinar plan with Andrew, perhaps hoping that we might have got a little more progress in 1 or 2 of these projects. But such is the workload of the ISB. Also, IAS 8, they are planning to clarify the distinction between a change of an accounting policy and a change of an accounting estimate, both of which trigger fairly extensive disclosure. And so there's an opportunity here to perhaps, particularly it's true when something is accounted for as a change of an accounting policy, when perhaps it would correctly be accounted for as a change in an accounting estimate. A significant issue here because of not only the disclosures that go with a change of an accounting policy, but also, in fact, a fundamentally different accounting implication. If something is correctly identified as a change of an accounting policy, then of course it's retrospective. It involves restating comparatives, including the opening equity at the beginning of last year. Whereas a change in an accounting estimate is simply from this point forward. And so they're trying to sharpen up our understanding. They're trying to explain the relationship between these things. Some of you perhaps are members of my LinkedIn group. We all love LinkedIn. And might, of course, remember that I wrote an article about accounting policies back in February or March this year. I commend that to you. And if you're not members of my LinkedIn group, then I'd be delighted to welcome you. One change that they are going to make is that the selection, or equally the movement from first in, first out to weighted average for inventory accounting would in fact be the selection or change in an accounting policy. There is no judgment or assumption needed. It's not an estimate. It is a measurement approach. And that is a classic example of when something should be accounted for as a change of accounting policy rather than a change of an accounting estimate. And on slide 14, if you're interested, those are the proposed definitions of accounting policy, accounting estimate. Not much that I can add to that at the moment. So again, we're looking for some project direction sometime in, I hope, the next month or so. Promised for June, so we've only got 2 weeks left to go. A slightly more fussy and minor change planned for IS8. This is a much more recent exposure draft published in the last week of March. So it's still open for discussion. And the issue that they've addressed is that it might be that an entity has to change an accounting policy, not because of a change in a standard, but actually because it's the publication of an argument by IFRIC, a so-called agenda decision. Now, of course, what that means is that when IFRIC publish an agenda decision, and you think, oh, okay, so that means I need to change my accounting, that would, in a sense, be entirely a voluntary change. And what they're proposing is to add to your threshold criteria for impracticability, so forget it, to add that preparers should weigh up cost and benefit to their readers of making a retrospective change arising from such a, we might say, minor change by IFRIC. So I'm much fussier, and I'm not particularly excited about it. Again, if you're unfamiliar with the way IFRIC operates and the way they publish their decisions, then again, can I point you to one, or I think it was the second of my 2 articles that I published on LinkedIn back in March that describe the nature of this circumstance. Now, IFRS 8 is world famous for triggering extensive disclosures, page after page after page, often 8 or 10 of them, but of course only in the context of quoted, listed entities. So for some of you, amendments to IFRS 8 that are inevitably going to follow from their post-implementation review may actually have no impact to you at all. But having said that, I've always firmly believed that training is not just training for today's job, Claudia, Debbie, Joshua, and so on. Training is also about tomorrow's job. Don't get me wrong, I'm not encouraging you all to leave Creston, but you don't know. And tomorrow you might find yourself with a client that is going to the market in an IPO, and therefore they would have to make segment disclosure. So even if you're not that excited about operating segment disclosure today, you don't know about tomorrow. So this was exposed in March last year. We're expecting feedback sometime towards the end of this year for a finalized standard or amended standard in 2019. Various amendments planned, in particular the description of a chief operating decision maker, CODM, and all of the disclosures around his title and role description and so on. Why might it be that segment data in the financial statements could be different to that is presented elsewhere in an annual report? They're looking, one or two of you might know, the aggregation criteria, which would enable you to take multiple segments and combine them into one in the context that they share similar long-term performance. And what they're trying to do is to add 1 or 2 further illustrative examples that might encourage a little more aggregation, which might just simply mean that you might be able to lose a column or 2 in a segment report. They're going to comment on voluntary additional segment information, and also they're going to try and improve the explanations about reconciling items. That's reconciling because when you add up your column, for example, revenue, you may not get the same answer as revenue at the head of your statement of comprehensive income. And so there may well be reconciling items that need explanation. And some are suggesting that IFRS 8 is a bit weak in that area. A standard that triggers a considerable amount of disclosure is IFRS 13. Been out for its post-implementation review. Feedback on what they intend to do is expected fairly soon. Certainly not until the second half of this year. I can tell you that the feedback from the ISB is that IFRS 13 broadly does exactly what it has to do. That might need addressing, of which disclosure is one of the issues. And the fair value disclosures, the level 1, level 2, level 3 movements and so on, are widely considered too much hard work. And what I believe they're considering is that they may group together level 1 and level 2 into a single level. Use observable data. Admittedly, one of them is an observable price, level 1, and the other one is observable inputs into a pricing formula. Quite honestly, they're the same level of risk. Whereas level 3, involving primarily unobservable data, that's a whole different ballgame. There's an issue associated with investments in quoted subsidiaries, associates, and joint ventures in the context of a parent who might be using a fair value method. And the question simply there is, if you've got 1 million shares in a subsidiary, Q, is your fair value simply PQ, the quoted price, times 1 million shares, or should it be recognizing the fact that actually, as an item, it is the unit of account? It's not 1 million shares or whatever, it's actually an investment in a sub, or equally an investment in a quoted associate or an investment in a quoted joint venture. And so it's known as the PQ issue. And so the question is, do we prioritize the observed price for a quoted sub, associate, or JV, or should we look at these things as a unit being a sub? Explore adding further examples and application guidance in the concept of highest and best use. And they're also going to, we think, add some commentary on the exercise of judgment. For example, judgment as to whether a market is active or not. And judgment in determining whether unobservable inputs are, quote, significant. How significant is significant? So some work being undertaken with IFRS 13 that will, I think, probably lead to reduced disclosures. Of ongoing projects that address issues is individually famous for its disclosure requirements is IFRS 7. And although perhaps the extreme example of IFRS 7 disclosures are seen within banks, many companies, particularly those that undertake a degree of hedging and going forward, all entities that have investments with a new classification model in IFRS 9 will trigger fairly considerable financial instrument disclosures. So there are, or this presentation is based on IFRS 7 as at today. There is in fact an alternative version of IFRS 7 available on the ISB website, which cross-references to IAS 39. Reason being, of course, some of you know that insurance companies are almost all of them going to soldier onwards with IAS 39, and they're going to delay the application of IFRS 9 until 2021. So it's a standard that has gone through many, many, many amendments. And so I think there's a sense in which the ISB were quite happy to have a bit more of a fundamental rewrite of IFRS 7 to make it compliant or consistent with the new IFRS 9. So in covering this version of IFRS 7, it will be an opportunity for me to remind you of some aspects of IFRS 9. So effective from January 2007, it applies to all risks arising from all financial instruments with some fairly predictable scope exclusions. And the risks, therefore, that are described in this standard are the credit default type risk, the risk of running out of money, liquidity risk, and then all types of market or pricing risk. And so that means it might be the market for other countries' currencies, so therefore an exchange rate risk. It might be the market for your own currency, reflected in an interest rate risk. And it could be any other type of pricing risk for commodities, shares, bonds, and so on. Last disclosure of the impact, the significance that financial instruments have had in the two primary financial statements, position and performance. And then it requires disclosure in both words and numbers. Exposure. There's mandatory application guidance, and there is also accompanying non-mandatory implementation guidance. So the objective of the standard is to ensure that users have disclosure provided that enable them to get their heads around the impact that financial instruments have had and the nature and extent of the risks arising from those instruments and how those risks are identified, monitored, managed, responded to, and so on. Are all financial instruments except, and this is fairly predictable, it's the same scope exclusions as we have in, for example, IFRS 9. So it doesn't apply to investments in subs, associates, and joint ventures unless you're using a fair value model. It doesn't apply to the rights and the obligations under employment pension plans, although they are, in a sense, very much like a financial instrument. It doesn't apply to insurance contracts. It doesn't apply to share-based payment, employee remuneration contracts. It doesn't apply to certain instruments that are accounted for as equity instruments under IAS 32 exceptions. Disclose information that enables users to evaluate. That implies primarily numbers. The impacts that financial instruments have had on position and performance. So that means specifically the balance sheet. That could be assets, that could be liabilities. Within the income statement, interest revenue, dividends received, and so on, and within equity, disclosures. And then in respect to the second half of the standard, dealing with risk disclosures, both words and numbers. So, your first talk today requires disclosure, amongst other things, of financial instruments have had upon equity. I mean, it specifically mentions the income statement and equity. Following statements is correct about financial instruments that have an impact upon equity. Now, let me explain. What I'm talking about here is those financial instruments that have a direct impact on equity, not the simple accumulation of profits or losses that occur within retained earnings. Everything ultimately gets accumulated within equity as part of, I suppose, retained earnings. What I'm thinking of here are financial instruments that have a very specific, a unique impact upon equity. And I've given you 4 choices. I have opened the polling question for you. Carefully, I've put in brackets the old reference that some of you will feel comfortable with of IFRS, available for sale. Although the new fair value through OCI category is not the same, definitely not, it's quite similar, shall we say, to the old IFRS category. Okay, it's nearly 3 minutes and on response. Now, you may find it too difficult. Some of you may feel you're a bit shaky on your knowledge of IFRS. Somebody answering now, and you got it right, whoever you were. I would like to close this poll one way or the other in 20 seconds time. 3, 2, 1. Learn from my explanation, even if you were not too sure that you wanted to make a pitch for the answer. The right answer is D. Oops, D. I mean, very assets and or liabilities that with a movements partly recorded in OCI, whereas choice C suggests that it's only financial assets that could affect OCI. It is liabilities as well under IFRS 9 because of the accounting for the effect of changes in credit risk. And then secondly, you should all know, because it's the same as it's been for the last 20 years in IAS 39, that derivatives designated into a cash flow hedge are accounted for through OCI directly into a cash flow hedging reserve, and then of course recycle back to the P&L when the risks are closed. Instruments that are held for trading, they of course only affect the P&L, fair value through P&L. Assets which cannot be fair valued affect nothing, P&L or equity, and C is, as I say, too restrictive. So who got that right? Correct answer is D. The point that I find here is not well understood in all my travels around the world, and it is the distinction between classes of financial instruments, which is frequently what IFRS 7 talks about, as opposed to categories of financial instrument, which is very much the way IFRS 9 talks about it. 7 requires disclosure by class, and as you'll see, it does this quite frequently. Financial instruments have to be grouped together into classes. Maybe quite a lot of instruments in a class, but it could be quite a lot of classes, because the classes are a description that is appropriate given both the nature of what you're disclosing, characteristics of instruments in that class. So for example, if you're disclosing interest income, by definition, those are interest-bearing instruments. Whereas if you're disclosing, say, dividends, those are by nature equity-type instruments. Another example of a characteristic of an instrument is whether it is, for example, a domestic company or a foreign company, whether or not it's quoted, or there are potentially as many classes as there are people on today's webinar and more. The challenge is going to be that this alternative grouping of instruments by class has to be reconcilable to the balance sheet line items. And the line items will be 3 of them, because there are just 3 categories. Amortized cost, fair value through P&L, and fair value through OCI. So the challenge will be that your class disclosures, for which you might have 6, 8, 10 different classes, somehow need to be pulled together to reconcile to category totals that will appear on the face of the balance sheet. So there's a bit of an exercise of spreadsheet design to achieve that. So a class is a grouping of financial instruments appropriate to the nature of the disclosed information, taking into account characteristics. And so by way of example, classes might be domestic debtors versus foreign debtors, secured debt versus unsecured debt, fixed rate instruments versus variable floating rate instruments, quoted versus unquoted, plain vanilla instruments versus instruments with features attached. And so there are immediately, I think we can envisage possibly 10 or more different types of classes that could be described. I say the challenge is actually in the building of the spreadsheet to enable those classes to be reconciled to balance sheet line item totals. So in many cases, IFRS 7 requires disclosure by class. That's what we mean by the classes. Or carrying amounts of each of the following categories. Now, these categories are the ones defined in IFRS 9, so that means either at fair value through P&L, or amortized cost, or fair value through OCI. And of course, the last item is the financial liability at amortized cost. So you've got three categories. Admittedly, you may have liabilities on one side, and you may have all three categories of financial assets. And also, separately, within the through OCI category, my third bullet, you need to separate those instruments which are bond-type instruments, so interest-bearing, from those instruments that are, in fact, equity investments, where you have designated fair value movements to be recorded in OCI. Okay, the bond type fair value through OCI is in fact individually in that area identical to the old AFS category, but the equity instruments designated through OCI is not the same as the old AFS category, because in IAS 39, when you sell an AFS instrument, you recycle the deferred gains and losses back through P&L. Whereas you should know that in IFRS 9, when you sell an equity investment that's been designated through OCI, you don't recycle anything. All you can do at the very most is a transfer within equity. Now, I'm going to come back to this, the idea of this slide, the category carrying amount disclosures, a little later, to A, point out the similarity with what the P&L account requires, but also to point out that alongside this disclosure of carrying amounts, typically will be a column that also identifies fair values of everything at the balance sheet date. The other thing to point out to you is that the financial asset and liability disclosure of instruments at fair value through P&L shows separately those instruments that have been designated to this category. I mean, another way of putting that is to say those instruments that you have chosen fair value through P&L, separated from the second bullet, those that are inevitably, unavoidably carried in this category because they are part of a dealing or trading activity. You see, the point is you've got no choice about fair value through P&L for those instruments that are in a trading category, whereas you have made a choice for designate as at fair value through P&L. Consider the following statements about the financial instrument description held for trading. And I've given you three possible statements about category, or I might say, of instruments that are held for trading. And my simple question, which of the above statements is or are correct? Which of the above statements is or are correct? And I've given you enough time to think about it, and so now I have opened your polling panel. I encourage you to respond perhaps a little quicker than you do. Otherwise, we are going to be a few minutes late finishing. Is or are correct. Things happen. You still hear me or see me? Whole partway through. Well, be a problem at the end of things. It's something that's happened at Cisco. Never seen that happen before. Well, my friends, I'm going to put you out of your misery, therefore, with the answer to this question. Held for trading, statements 1 and 2 only are correct. Statement 3 here, about whether or not it might or might not meet the definition of current, that is entirely, totally a question of the requirements of IS 1. It's nothing to do with the financial instrument category. I take a good example. Your trade receivables you are also current. But for trading, there is no sense in which you'll be buying and selling trade receivables and trade payables. So the reference to current or non-current is entirely derived from the application of IAS 1. Don't know what happened to that question, but I was aware that the timer had stopped running and that nobody seemed to be able to respond. So let's move on. Tanya, can you confirm you're still able to see the slides? Yeah? Now, if an entity has chosen to designate as at fair value through P&L instruments that would otherwise have been fair value through OCI or even amortized cost, then the problem is that the fair valuing would not necessarily give information about the extent of a credit exposure. A debt instrument at AEC would reflect very clearly the future payments expected, now discounted maybe. If interest rates have rocketed up, the fair value could be quite tiny. And you might say, well, there's not much exposure. Until you say, yes, but there's $1 million worth of money outstanding. So there are requirements for disclosure about the extent of credit risk and how you may or may not have mitigated that risk, and then the changes in fair value for the period and to date for the extent of the risk and the credit derivative. So in this slide, there is by implication the need to separate the impact of credit risk. Got me? Impact of credit risk. Now look at the next slide. Liability designated as at fair value through P&L, and there are changes in fair value due to credit risk, then again you need disclosures that separate out that credit risk movement as well. My next couple of slides build an example of how to separate out to determine the credit risk element. So changes in the fair value attributable to the credit risk element could be determined, well, you could possibly determine by an application of, say, a BB minus credit rating to the remaining cash flows, and then compare that to the application of a C plus credit rating. I mean, in theory, and certainly somebody at the likes of S&P or Moody's would be able to do it that way. But the alternative that's suggested is actually a much simpler way of doing it, and it is to identify the change in fair value that is not changes in market conditions, in other words, market risk. And so what you do is say, how much of the change in fair value can I attribute to a change in, say, an interest rate or a currency rate? And then the balance of a change in fair value has to be, by default, arising from changes in credit risk. So market conditions that give rise to market risk would include exchange rates, commodity prices, benchmark interest rates, for example. And there's a comment also about the more complex unit-linked feature, which I'm not going to comment on today. Let's have an illustration. And whatever, X issues a 10-year bond with a par value of, that should read of, 150 thou, and an annual fixed coupon of 8%. And if they issued it at par with a fixed coupon of 8%, then it follows that that 8% must also, at that instant in time, be the yield or the effective interest rate, the IRR of this bond at that instant, assuming that it gets redeemed at par as well. Now, I'm also going to tell you that on the day they issued that bond, LIBOR, an observable benchmark interest rate, was 5%. And therefore, we can immediately infer that there was a 3% credit spread. Now, at the end of the year, the fair value of that bond had gone to 153,811. And you say, well, Ian, that could well have happened if LIBOR went down. And I'll tell you, LIBOR has gone down to 4.75. But the question is, would that fair value of 153,811 be consistent with that LIBOR, or is it more, or is it less? The difference being attributable to a change also in the credit spread. The X needs to make a couple of policy decisions. It identifies LIBOR as its observable or benchmark interest rate, so confirming, therefore, that the 8% initial yield could be described as LIBOR plus 3. So assume a so-called flat yield curve. In other words, that changes in interest rates arise from just a parallel movement in the yield curve rather than a twisting. Sophisticated treasury managers might also be able to build in a twist. But this company says, let's assume it's a flat yield curve, and only changes in LIBOR would be relevant to changes in the value. And so, at the issue date, on the 1st of January, LIBOR was 5, and therefore there was an entity-specific, a credit spread. And we're told that at the end of the year, LIBOR has gone down to 4.75. If credit rating had been identical, it would still be 3. And the reason is that the market would be discounting future remaining cash flows at 7.75%. Change in credit risk. And what we now do is to use that 7.75 as a result of an observed change in a market rate and an unchanged credit risk as a discount rate. Now, at the end of the year, there are 9 remaining cash flows of 12,000, and that's 8% on 150. And then there is now, in 9 years' time, a repayment at par, we're assuming, of the nominal amount, 150,000. If everything had been constant, the market would value those cash flows using a 7.75% interest rate as 152,367. We have observed a fair value of 153,811. The implication must be, therefore, that this company's credit rating has improved. Therefore, the premium, the credit spread, has actually gone down a little, so the fair value has gone up. And that 1444 is the disclosure requirement. It's an indication then of the amount of the change in the fair value that is attributable to changes in the credit risk. And that's required both for liabilities at fair value through P&L and for assets that are at fair value through P&L when they would otherwise have been AC or fair value through OCI. Additional disclosures related to equity instruments which are designated as at fair value through OCI. Remember, this is nearly the same as the old AFS, but there's no recycling. So the bullet here refers to internal transfers within equity. There is no recycling. Suppose is how you selected certain investments to be designated in this way. And it's clear in the development papers to IFRS 9 that the idea behind such equity investments could be described as so-called strategic investing. Instruments, equity instruments that are being bought and sold in a trading activity, and they're not yet, at any rate, subsidiaries or associates or joint ventures, but they might be pretty substantial, held for strategic reasons. For example, it may be an investment in a competitor. It may be an investment in a customer or a supplier. It may be an investment in a horizontally integrated equivalent sort of company, where you're making the investment for the purpose of strategy, and therefore, if fair values rocket upwards or collapse, you say, well, it's of no consequence to me, because I decided I will hold such equities. So, old standard IFRS 9 didn't call them strategic. It says particular investments. I suppose how you got to that point. You need to disclose what the fair value is at the period end. You need to disclose whether any dividends have been recognized. You need, as I say, to disclose transfers within equity, which would presumably mean you have de-recognized, probably you've sold some of those items. And therefore, additionally, why have you sold? What was the fair value at that instant? How much was the accumulated gain or loss at that instant? Because remember, it's not going to be recycled or reclassified into P&L accounts. Options are still a reality in IFRS 9, but they arise because of a change in the entity's business model. Very rare. I mean, IFRS 9 says this will be rare. So I think these disclosures are equally going to be quite rare. Model and how much was transferred in and out of various categories. Of disclosures about offsetting. If you remember, these were amendments that were introduced to IFRS 7 in, I think, 2012 or 13. And they arose because particularly US GAAP has a different model of offset 9. And so entities must disclose, they don't need to do it in their interims, the gross amounts have been offset, the net, and then any further offsets to give rise to a bottom line net credit exposure. And the best way of illustrating that is to imagine a set of financial statements where under, say, IFRS, the net amount applying the standard is 90, but perhaps under US GAAP, for the same circumstances, exactly the same circumstances, it could be 60. And the reason why they're different is because the offset model in those two sets of standards is different. Now, working backwards from that, different amounts have been actually set off, but when we work finally back, you say, oh, well, Ian, it's the same gross amounts before offset, 100. And equally, working forwards, there are other amounts that may be in scope of offset, but not actually offset, to give us a net amount, which again is the same for all preparers. And so the purpose of the disclosure is to enable some sort of comparison to be made between IFRS and other GAAP, US particularly, but Japanese GAAP equally. Disclosures include information about collateral offered and collateral held. Not much that I can add to that slide. About compound instruments, in particular, whether or not there are instruments that contain multiple embedded derivatives. And look at this carefully. This is scary. These are disclosures about your own loan on. Okay, is the details of any default you've made during the period, the total carrying amount of loans that are in that position at the reporting date, and have you done anything about it to either renegotiate the terms or remedy your terrible crime in that post-balance sheet period. So up to a coffee break. One more question. Which of the following instruments have multiple derivatives? Which instruments issued by multiple embedded? Clock is ticking. So that's as soon as we close this poll. One of them, which of these contains multiple embeddeds? A selection just so as I know the polling is working. Just pick it. Thank you. Know that the polling is working. I think the Cisco WebEx computer must have had a bit of indigestion 10 minutes ago. Issued contain embedded derivatives. Okay, that's the problem here, or the circumstance here. Um, Seems like just, oh, there's a third person responding. Go minutes. I'm going to close this poll in 10 seconds time. 3, 2, 1. Okay, so responded. Unfortunately, all three of you got it wrong. Um, all of these have at least one embedded derivative. So the conversion feature, the bond warrant feature, the callable pref, but the only one that has multiple embedded derivatives is D. The option to convert, and then a second option to call for the bond. That may be either the company with the right to call it for repayment, or it could be, in fact, the holder with a right to put it to the company. So a callable and convertible bond would have two embedded derivatives. Okay, let's take a short break for some tea or coffee. 5 minutes, please. I'll see you soon. Thank you. You can take your leave. I'm perfectly happy for that. Thank you for your help. Bye. Okay, everybody, welcome back. I trust you're suitably refreshed. So, in the income statement or in the statement of changes in equity, so you've got a choice actually here. This could be on the face of the statement of comprehensive income or in the notes. Net gains, net losses. That is at fair value through P&L, separating the designation from the unavoidable held for trading, losses on liabilities, identifying therefore the part that relates to the credit risk, is at amortized cost, equity instruments where you have designated to be at fair value through OCI, and then the fair value through OCI debt type instruments, separating again the amounts recorded in P&L from the amounts taken through OCI separately. So it's total interest income and interest expense for those that are not at fair value through P&L. If you're a bank or investment type activity, fee income, trust, fiduciary services, that sort of thing. You also have to disclose the interest income that's been recorded on impaired financial assets and an analysis and reasons for the amounts in respect of derecognized financial assets of AC. Now that should be instruments that have matured. Remember, under IFRS 9, you can only very occasionally argue that an instrument held at AC is disposed of in advance of its maturity. And that would be, for example, for reason that it has failed an investment criteria. It's failed it because it's now dropped to below BB-. Other disclosures include a summary of the significant accounting policies and additional disclosures including your policy for accounting for regular way transactions. Regular way decision involves whether you account for something on trade date, that's when you pick up the phone and transact, or settlement date, which is typically a week or two later when you settle with the relevant. And then there's quite extensive information about hedge accounting required. I'll expand on that in just a moment or two. A question for you. Which of the following is the correct description of so-called regular way transactions? Now, if you look at my three choices that I've given you, all three of them refer to delivery within regulated conventional time frames established by a marketplace. So that's not the question. The question is, do regular way transactions concern purchase and sale of financial assets? Do they concern purchase or sale of financial assets and or issues of financial liabilities? Or thirdly, do they concern issues of equity instruments or financial liabilities? So in all three cases, your question is about the scope of regular way accounting. In all three cases, you've got the same description about delivery of asset, transfer of cash, and so on, within time frames established by convention in that marketplace. And you'll see that I've opened the polling panel for you. We are 1 minute later than we were this morning at the moment. So we'll be finishing at about 2 or 3 minutes past 6. So to make a prompt response to this question, if you know it, and then I'm going to close the poll perhaps after 1.5 minutes. Need a response. I mean, it's something you either know or you're responding. Thank you. So, regular way, a very common description in America, especially. Just assets? Is it assets and liabilities, or is it instruments issued, liability or equity? In 10 seconds, because time is of the essence here. We're going to be a few minutes late finishing. I'm going to close the poll in 5, 4, 3, 2, 1. Okay. One of you who did respond. The correct answer is, in fact, A. Okay, it's only a description that is relevant to financial asset accounting. A further sub-question could be, is it just for purchases, or is it just for sales, or is it both of them? It is, in fact, for both purchasing and or selling financial assets. It's a question that I often get asked in my travels, and very few people get it right, in fact. If you use an allowance account instead of a direct write-off or write-down of an impaired asset, and so you're required to disclose the criteria for deciding when to use an allowance account and to write off that amount. Criteria you're using to determine that there is a significant increase in credit risk. Additionally, you're asked to disclose how you have computed the net gains or losses on each category. For example, does it include interest income? Yes or no. Does it include dividend income? Yes or no. You have to disclose your accounting policy for financial assets that are being renegotiated. By definition, they are in distress, we might say, and the judgments made in the application of your accounting policies. There are some fairly extensive hedge accounting disclosures, but do you know, ladies and gentlemen, hedge accounting under IFRS 9 is almost completely identical to hedge accounting under IAS 39. It's one aspect of IAS 39 that in a sense they got right. What changed, of course, in IFRS 9 is the criteria by which you measure hedge effectiveness. But the types of hedges, cash flow hedge, fair value hedge, net investment hedge, the accounting, the nature of the risks that are being hedged, all of that should be identical under this standard as it was under IAS 39. So, ladies and gentlemen, you should be comfortable with the hedge accounting disclosures that are made under IFRS 9. There's no discernible difference. And this calculation is quite different, but it still gets recognized in P&L. It's just a different way of computing how much ineffectiveness has arisen. Because, of course, in IFRS 9, there is no retrospective testing of hedge effectiveness. And the risk management strategy, how your hedging activities might affect amounts, timings, and uncertainties, and impact. How has hedge accounting affected the statement of comprehensive income and the statement of changes in equity? Quite detailed illustrative guidance on how you might achieve those objectives. That relate to fair value, now there's a lot of them, of course, in IFRS 13, but I promised you would see this again. When you do your disclosure of the totals for each category in the balance sheet, here it requires, in a way that enables comparison with carrying amounts, it requires of each class. And so conventionally, in the disclosure note of the total carrying amounts, you just add one extra column to disclose the total fair values of each class. Remember, these are classes. There is guidance on day one profit recognition that I'm not going to go into. It's a banking issue. Disclosures are clearly not required, a fair value, when the carrying amount is already a good approximation. Read for that, of course, trade receivables, trade payables, short-term receivables and payables, where the carrying amount, because it's 2 or 3 months at the most of interest period, are frankly the same as fair value. And the hierarchy disclosures, of course, we find them in IFRS 13. On in its second half to the qualitative and quantitative disclosures relating to risk. Disclosure, of course, could be part of the financial statements or could be incorporated into a separate publication and then cross-referred to. Some organizations publish on their website a separate risk report, separated from the annual financial statements. That's fine. But these disclosures, even if they're put in a separate document, must be audited because it's IFRS 7 that demands both words and number disclosures. Now, can I please just make the point that words and numbers are there to enhance understanding of readers, and therefore they should be consistent. And sometimes we find they're not. And I've seen examples of that in some of the world's largest companies. Can I also point out to you that disclosures of quantitative amounts should perhaps be symmetrical. So disclosing the impact of a change in an exchange rate, you might show what happens if it goes up by 10%, down by 10%. It's logical that you are symmetrical in that disclosure, but that's by no means what I've seen. I saw a company that disclosed the impact of a change in currency exchange rate by showing what happens if it goes up by 10% and what happens if it goes down by 1%. And it carefully, you said, wow, they've got upside potential and they've limited downside risk. Well, they must be using options in their hedging strategy. And in fact, all they've done is to show what happens if it goes up by 10 and goes down by just 1. And that's the spirit of these disclosures. Has risks arising from interest rates and also risks arising from currency exchange rates. They have prepared disclosures that identify numbers for the interest rate exposure and that produce words to describe the risk management architecture for currency risk. So you've got numbers for interest rate exposure and words for currency exposure. And then they have said risk management architecture for interest rate risk is broadly similar to currency risk management. Very simple question, ladies and gentlemen. Is it likely to be adequate? Or no is what I'm looking for. Illustration, this question was in fact derived from a global company, actually a fairly well-known company, that chose to be a little selective, shall we say, with the words and its numbers together. Same company that showed the +10 -1. In fact, there was interest rate was plus 1% minus 0.1 in their interest rate disclosures. And it was in the light of that type of disclosure that the ISB made the amendments to IFRS 7 about pointing out that words and numbers should be complete and consistent with each other. Good. So one of you has answered, and you quite correctly identified that it is unlikely to be adequate under IFRS 7 to describe one set of risk management architecture and then say all the others are broadly similar. That's not going to be good enough. Equally, if you describe risk management architecture, you need numbers as well. You can't have one without the other. You can't have the other without the one. Each type of risk. What's the nature of the exposure? How do you monitor it? How do you respond to it? How do you measure it? How do you manage it? And so on. And is this the same or different to what you've done in a previous period? Doing that, you might, for example, include descriptions of the risk management committee functions, the scope and the nature of risk reporting, policies for hedging. So, for example, a statement that derivatives are used, but only for mitigation. You're not the team are not allowed to use derivatives for speculation. How do you monitor the effectiveness of your risk management? And also, how have you avoided perhaps having a concentration of risk, say in a particular geographic area or in a particular type of interest rate risk. And for each type of risk, sensitive data about the exposure on information that would already exist because it's presumably already being reported to risk management personnel, key management personnel, if you like, as described in IS 24. And then the standard says, here is a list of disclosures that you may work on to the extent that what you've chosen to do may not complete that requirement. And so, for credit risk, failure of a debt, credit risk, quantitative and qualitative information that allows readers to understand the impact of expected credit losses, changes in credit rating, improvement or decline in credit rating. What's the total of the exposure? Are there significant risk concentrations? Very, very extensive disclosures. I've copped out at this point because it was going to need another 12 slides. Not possible for today. Most of you, of course, will be using some sort of IFRS 7 disclosure checklist to check these things. Run out of money. Now, the reason you'll run out of money is because of the maturity issues associated with your straight financial liabilities, and then maturity issues that arise with your derivative financial liabilities. So for both of those, a maturity analysis. And then a description. How do you manage? And that description might also include, therefore, how you manage short-term treasury activity. Because one way of managing difficulties with liability maturity is to have some cash available in treasury type investments that can be realized in extreme circumstances. And then market risk, okay, that's the change in value of cash flows because of changes in market prices. That could be the market price for other countries' currency. That could be the market price for your own currency, in other words, interest rate risk, and all other types of pricing risk. Commodities, metals, bonds, shares, and so on. Other exposure of a sensitivity analysis for each of those market risks. So, by how much could those interest rates go up by, down by, currency exchange rates go up by, down by, prices of tin go up by, down by. And it's in this area where some companies have been perhaps a little less than transparent. That's it, plus 10, minus 1. The sort of information that one would expect to see. Also remember that it does say changes in a risk variable that is reasonably possible. One company I saw disclosed changes in interest rates of plus or minus 10 basis points. Okay, that's 1%. And to my knowledge, there's no country in the world that measures changes in interest rates smaller than 25 basis points. So again, not actually a reasonably possible movement. And you need to disclose your models and methods used in doing that. Additionally, you might have a sophisticated treasury function that models interdependencies. For example, some of you will understand that inflation rates, interest rates, and currency exchange rates are probably all interrelated by things like the expectation theory, the Fisher international effect, and so on. And if you've got Treasury people who can model it that way, well, fine. You just have to explain how they did it. It's pretty sophisticated stuff. And I don't want to dwell on this because, again, this has not changed. There are disclosures relating to of financial assets. Now, immediately you see that word, you think of banks. Okay, so these are, generally speaking, disclosures that are required for financial institutions. The problem being, of course, that financial institutions typically do not sell financial assets, they transfer. So, for example, a sale and total return swap, or into a special purpose entity. And these disclosures were introduced in the light of the 2008 global financial crisis to improve disclosure relating to bank type activity. And therefore, for, I think, all of you, they are probably of some doubtful application in the client work that you face. Be aware that there are extensive disclosures. You know, what type of transfer has taken place? Why do you still retain some risk and reward? What's the relationship between an asset transferred and the pile of cash, probably accounted for as a liability, that you received? So these are all very much disclosures for the financial sector, arising in the light, in fact, of the financial crisis back in 2008. There is some supplementary disclosure required for this year and this year only. The impact in loss impairment are the conversion from an IAS 39 impairment model to the IFRS 9 expected loss model. And they're quite extensive, but predictable in the light of that fairly fundamental change. What's required in determining the classes are grouped based on an analysis of the type of disclosed information and the characteristics of those instruments. And that requires some imagination, that requires some judgment to undertake. Secondly, there are judgments required in determining how you might flex the sensitivity analysis that was described there in that market risk section. Otherwise, one has to say that IFRS 7 is just a mountainous set of required disclosures. And in that sense, company auditors will apply, hopefully, an up-to-date disclosure checklist. Coming up 6 o'clock, we have finished on time. Thank you very much for being with me, all of you. Can I take the opportunity of wishing you a happy summer and a good summer holiday wherever and whatever you're doing. And I will hope to see you again, I think, sometime in late September. Being with me, and have a great afternoon or evening wherever you are. Thank you. Bye-bye.